Welcome to the Deep Dive. Today we are cracking open the Q3 fiscal year 2026 earnings call for HealthEquity, ticker HQY.
And our mission today is pretty straightforward. We're going to cut through all the prepared remarks, all the noise in the Q&A to really get you the most critical intelligence.
Right. We're focusing on, three main things?
Exactly. First, how real is this margin recovery? Second, the new strategic pivots they're making, think AI, new markets. And third, what the updated guidance tells us heading into the really critical Q4 enrollment season.
And, the initial vibe from the market, it was just palpable relief. The results dropped after the bell and the stock didn't shoot to the moon or anything. But that modest little bump in after-hours trading, it signaled that investors are starting to buy into the stabilization story, the idea that, okay, the business is getting back on solid ground and the margin recovery is real.
It was a collective sigh of relief. This quarter wasn't just about hitting the numbers. It was about showing that the really serious operational issues from last year are, finally in the rearview mirror.
Okay, so let's get into those hard numbers. What drove that positive reaction?
Well, first up, non-GAAP EPS. It came in at a remarkable $1.01.
101. And just for context, the street was looking for something around, 91 cents?
Around 91, yeah. So that's a 10-cent beat right there. A really significant upside. Revenue was solid, too, $322.2 million.
Which is a healthy 7% year-over-year growth. Pretty much in line with what people were expecting.
But if you really want to know why the stock moved, you have to look at the profitability. Adjusted EBITDA, it surged 20% year over year, hit $141.8 million.
Okay, and that leads to the big one, the main takeaway.
The main takeaway of the entire quarter. The adjusted EBITDA margin reached an impressive 44% of revenue.
44%, that's the number you need to remember. We're talking about a 500 basis point expansion from the 39% margin they were running just a year ago.
I mean, that is a structural shift in how profitable this business is. It's not just some cyclical blip.
And management was not shy about it.
Oh, not at all. The CEO came right out and called Q3 a record quarter. He was emphasizing that this kind of EBITDA and EPS growth gives them undeniable momentum right before their big enrollment season, their harvest season, really.
Okay, so let's unpack that, this profitability engine. A 500 basis point jump. That's not a small thing. How did they pull that off? And more importantly, is it sustainable?
It really boils down to two things. Some pretty relentless cost control, but mostly the leverage from their custodial revenue.
Right.
Their gross margin just leaped from 66% last year to 71% this quarter. And that custodial revenue, which is basically the passive income they earn on cash and HSA accounts, grew 13% to $159.1 million.
So HQY is getting this just massive financial tailwind from the current rate environment. Do we know the exact yield they got on that HSA cash?
We do. The annualized yield came in at 3.53% for the quarter.
3.53%.
That's the bedrock of their profitability right now. I mean, just to give you some context, the other two streams, service revenue and interchange revenue, they grew about 6%. So that custodial number is the real profit driver here.
Which means the asset base itself is what really matters for the long-term health of the business. So what are the core asset metrics telling us?
The metrics look really robust. Total HSA assets climbed to $34.4 billion. That's a 15% jump year over year.
That's the flywheel spinning.
It really is. And what's fascinating is the split. You've got $16.9 billion still in cash, but now $17.5 billion is in invested assets.
And the fact that invested assets are now slightly bigger than the cash pile, that's important, right? It says something about their users.
Absolutely. It shows maturation. Total HSA accounts hit 10.1 million, which is up 6%. But the really high-value accounts, the ones with investment features, they grew twice as fast at 12%.
Okay.
So your most engaged, highest net worth customers are going deeper with the platform. They're not just using it for spending. They're using it as a real investment vehicle.
We have to talk about the elephant in the room, though. The thing that really rattled investors last year, the fraud costs, that was a $17 million hit in Q4 of 25. What did we learn this quarter?
This might be the single most stabilizing data point in the entire report. It directly addresses that skepticism. In Q3, fraud costs totaled about $0.3 million.
300,000.
Yeah, it's dramatically lower. Management made a point to say this is way below their internal target, which is 1 basis point of total assets per year.
So let me just do the math on that. Total assets are $34.4 billion. 1 basis point would be about $3.4 million a year. They came in at $0.3 million for the quarter.
That's definitive proof. It shows that security investments are paying off and that the recovery is based on real operational fixes, not just, riding the interest rate wave.
It changes the whole story. It goes from HQI has a security problem to HQI contained a security event.
That's a critical narrative shift. And with that cleaned up, they give us a clean beat and raise on guidance.
Right. So how confident did that make you feeling about Q4, the big push?
Well, they raised the full year outlook across the board. Revenue, EPS, adjusted EBITDA, all nudged up. It's not a massive raise, but it's a confirmation from management that they expect this momentum and margin control to continue right through open enrollment. It reinforces that clean execution story.
Okay, so let's switch gears a bit. From defense, cost control, fraud mitigation to offense. The strategic pivots. Management was talking a lot about transforming the platform.
Yeah, and it's centered on two huge themes, AI and what you could call the new healthcare economy, specifically GLP-1 drugs and the ACA market.
So let's start with AI. What are they actually doing?
This is where you see the future operating leverage. They announced a big partnership with a company called Parloa for agentic AI. Now, that sounds like a bunch of jargon.
It does.
But here's what it actually means. They're shifting their support model away from just having humans answer the phone to having advanced AI systems handle complex multi-step problems.
Give me a real-world example. How does that work?
Okay, so think about a member calling in. They need to update a beneficiary, change their HSA contribution, and request a new card, all in one call.
Which would normally take, 15 minutes with a person clicking through different systems.
Exactly. Agentic AI can now guide that member through all three of those steps seamlessly over the phone or web without a human ever getting involved. It's already automating claims payments and cutting down service costs. That's how you lock in that SG&A leverage.
That makes sense. It's not just about a better experience. It's about fewer expensive human hours. Okay, now on to the healthcare side. The GLP-1 focus and the new direct enrollment platform.
This is a really bold move to grab market share outside of that traditional employer channel, which can be, pretty slow moving.
So what's the GLP-1 play?
It's a specialized telehealth and enrollment platform. And it's crucial because these new weight loss drugs are just exploding. It's a huge amount of high-value spending going through the system. By integrating GLP-1 management, HQI captures more of that transaction volume.
Which means more interchange fees, maybe some platform fees, a nice high-margin business on the side.
Exactly. And the direct enrollment platform, that ties into these huge policy tailwinds like the ACA Bronze Plan expansion.
Right. Management was talking about this. HSAs are being seen as a key tool for affordability, and now millions of people on these bronze plans are eligible for them.
Precisely. This could be their biggest market expansion opportunity. The direct platform lets individuals open and fund an HSA without going through their boss.
So they're going straight to the consumer, targeting those 7 million newly eligible people directly instead of waiting for companies to change their benefits packages.
It's an aggressive land grab. And that explains why the CEO said they're upping their sales and marketing spend in Q4. They see an opening and they're going for it.
And while they're going on offense, they also made a huge move to de-risk the whole story. Let's talk about the hedge.
This is a bit technical, but it is so important. They expanded their 5-year Treasury forward hedge to a cumulative $2.25 billion. They're basically buying financial insurance against interest rates falling off a cliff.
And they locked that yield in at 3.94%. How does that compare to the 3.53% they're getting now?
It means they've guaranteed that for over $2 billion of their cash pile, they will earn almost 4% for the next 5 years, no matter what the Fed does.
So it insulates a big chunk of that custodial revenue. It makes their earnings way more predictable.
It's a crucial move. It helps them build that case for a fintech valuation, not a cyclical one. It takes one of the big overhangs off the table.
Okay, and quickly on capital allocation.
Very disciplined. They bought back about 1 million shares for just under $94 million, but they're keeping their powder dry, leaving their revolver open for opportunistic acquisitions of smaller HSA portfolios. That flywheel is still turning.
So let's bring it all together. A clean beat and raise, 500 basis points of margin expansion, fraud risk is contained, smart pivots into AI in new markets. So why did the stock only get a moderate 2.4% bump after hours? What's the market still worried about?
I think investors are still discounting two things. First, the durability of those fraud fixes. One great quarter is fantastic, but they want to see it for 2, 3, 4 quarters. They need to prove it's a permanent fix.
The market needs to see that $0.3 million number hold before it gives them full credit.
Exactly. And second, look, the hedge is great. It's huge. But HQY is still fundamentally sensitive to interest rates on the rest of their cash pile. The market still sees them to some extent as a rate-sensitive business, even as they're trying to change that story.
Let's put their stock performance in context. Over the last 3 months, HQY is up over 20%, crushing the S&P 500 6%. But zoom out to a year, and they're only up about 3% while the S&P is up 13%.
And that gap, that's the opportunity. It suggests that if they keep executing this cleanly, there is a lot of room for the stock to catch up.
So the next catalysts are key.
Absolutely. The final numbers from open enrollment, the adoption rates on these new platforms for GLP-1s and direct enrollment, and of course, making sure Q4's fraud costs stay low.
Which brings us to our segment. This is not financial advice. This is where we take all the data we've pulled and spin up a plausible but outrageous trade idea.
And given everything we've talked about, the strong asset growth, the proven margin expansion, the pivot into high-growth areas like the ACA retail market, the old way of valuing HQY, it just feels like it's cracking.
Okay, so what's the pitch?
The pitch is built entirely on this narrative shift. HQY is moving from being seen as like a cyclical, insurance-adjacent benefits administrator.
Which gets a lower multiple.
A much lower multiple. And it's becoming a structurally growing, defensible fintech platform with these aggressive AI-driven efficiencies. So the trade is long HQY and short a basket of those traditional, slower growth benefits administrators.
So you're betting that the market is going to be forced to re-rate the stock, that those sustained mid-40s EBITDA margins and the big interest rate hedge will make investors see them more like a high-growth, fee-based financial platform.
Precisely. They are using their scale and their tech to drive a kind of efficiency and stability that those traditional players just don't have. Their earnings are becoming higher quality, and that deserves a higher multiple.
Fantastic. So to recap everything we've extracted today, HQY put up a clean beat and raise, showing really powerful margin recovery. They are now officially moving to offense, going after new markets like the ACA expansion and using AI and financial hedges to lock in future profits.
The message from management is clear. The era of just putting out fires is over. Now it's all about maximizing scale and efficiency.
And we'll leave you with this final thought. Management said there are about 7 million bronze plan holders now eligible for HSAs. So is that 7 million the actual ceiling for this new market? Or with the ongoing affordability crisis, are we about to see a huge migration from silver and gold plans down to bronze, dramatically expanding the entire HSA universe, making this pivot exponentially more valuable?
That's the big structural question that will define their growth story for years to come.
We'll leave that with you. This concludes our deep dive into the HQY Q3 earnings call. And we will remind you again, this is for informational purposes only and is not financial advice.